Hey, welcome back, subscribers. It is an exciting time here mid February because we have a new wave of SEC filings starting to pour in now from the biggest institutional investors, which means we, the public, get to see which stocks they've been buying from the most recent quarter. And hey, what a better way to kick things off here than by looking at the notorious BlackRock, who is by far the largest asset manager in the entire world with many trillions of dollars invested in the stock market. So let's run through five of their largest purchases that they just made. Some really interesting ones, by the way. You're going to probably like some of these. And I'm going to give you my own opinion on each one of them as we run through them. I'm even going to rank them from best to worst too based on my opinion. So it's always fun to do this. Hit that like button. Let's just go ahead and jump straight into it, my friends. All right, so sorted here by percentage increase. Well, we're going to start with the smallest of the five, and that was in Caterpillar, ticker symbol CAT, CAT, which BlackRock increased their position on by only around 5%, yet that still equates to more than $1 billion worth of new purchases just during the fourth quarter alone. That's how insanely large BlackRock is. Speaking of size, though, this one does make perfect sense for a giant like BlackRock to be loading up on, since Caterpillar is a world leader too in the gigantic infrastructure market, which is actually a very large trend that I believe we'll see unfold throughout this year. In fact, the American Society of Civil Engineers recently found that the US alone will need to invest over $3.5 trillion into surface transportation by 2033, with additional investment required across energy, aviation, and water systems too. And globally, well, we're looking at a massive $80 trillion requirement by 2040, according to reports from Swiss Re. Well, when you think about who the king is really of the machinery, much of it that is needed for building all of those roads, bridges, and tunnels, it's definitely Caterpillar, who literally supplies the heavy machinery that builds much of the world's infrastructure, providing everything from those massive 400-ton haul trucks and hydraulic excavators to the motor graders and dozers that move the very earth that we build upon. But what's really interesting here is that they aren't just about like dirt anymore. They are even moving into the AI space, if you can believe it, by providing natural gas generator sets and massive battery storage systems to power the next generation of data centers. It's pretty crazy stuff, and it really illustrates just how well they've adapted to changing trends in infrastructure. With the results being strong financials coming off of all of this that just continue to break record highs on both the top and bottom line, usually growing by around a double-digit percent too. Plus, for any of my dividend fans out there, well, that resilience has enabled CAT to also increase their payouts for over 3 decades in a row, which is a kind of reliability that, big institutions are obviously going to love to see when they're investing in a stock like this. But because of that payout ratio is because it's so low, it'll likely continue to grow larger in future decades too. However, the only issue for me personally, as someone that is not already in the stock, is that their phenomenal business performance and dominance has already caused the stock price to skyrocket over the past decade, climbing by over 1,000% during that time, which subsequently lowered that dividend yield down to only less than 1%, while also raising their valuation to a forward PE that is around 50% more expensive than the sector, and whopping 80% higher than their own 5-year average too. As a result, I just think that their upside is going to be pretty limited from here specifically, which analysts seem to agree with as well, as the average price target out there actually sits about 14% lower than where the stock trades today. Again, I love the business, although I do worry about maybe some rising competition from China specifically. They tend to sell similar machineries for much lower prices. That could be a threat over time. But the brand is very strong, I'll give them that. And I do think that it allows them to hold at least some pricing power. But I'm just not sure that there's enough of it here at this high of a valuation to warrant the stock purchase. I'll still rank them around the middle for now at number 3 until we take a look at what the other stocks are here on this list. But it's not a stock that I plan to buy myself, at least not at the moment, but I would love to pick it up on a future dip. Okay, moving on though to the next purchase, we actually have a super popular name here in the AI space right now. This one is very, very interesting. It is, of course, Oracle, ticker symbol ORCL, which they added close to $2 billion of it during the quarter at an increase of more than 5% too. This one, I got to say though, it's been an absolute roller coaster of a ride when you look at the stock price. And I'll show you what that looks like here in just a second. We'll take a look at that price. But for those of you who might still maybe only think of Oracle as that like old school database type of company, we should know why they've become really one of the most exciting AI plays now in recent years. Now, historically, they dominated the world of enterprise software and databases, acting as almost like the digital filing cabinets for most major corporations. But more recently, they've pulled off a very large pivot into what they call Oracle Cloud Infrastructure, OCI. And what makes them stand out in that crowded, I can't speak today, crowded cloud architecture market is that OCI was built a little different than traditional cloud players, optimizing almost entirely for the intense workloads of generative AI, which is why companies started lining up to use these almost like digital factories where they can train and run their new AI models. And because of that, as well as all the other many different software as a service products that Oracle sells, from ERP to supply chain management to healthcare records to financial systems and much more, well, the company has essentially created this giant high margin ecosystem where customers don't just rent cloud capacity, but they end up running huge portions of their business actually on Oracle's software stack and their cloud infrastructure as well. And that combination just really breathed a ton of new life into this company, notably their growth rates, as both sales and profits started to break new record highs, resulting in demand for the stock skyrocketing too. Which just a few months ago, that hype in artificial intelligence got so intense that it even briefly made the founder, Larry Ellison, literally the wealthiest person in the entire world. It's kind of crazy. However, since then, the stock has actually tanked, losing more than half of its entire value from the top. Now, on one hand, the business looks like a total no-brainer on paper as their sales and EPS continue to grow and are even expected to surge by another 19% and a whopping 73% respectively this year. Plus, they have a monstrous backlog of over $500 billion, which is also up over 400% year over year, while their cloud revenue continues to steal market share too and is growing at over a 30% rate. But the worry among Wall Street is that about 300 billion of that massive backlog is tied directly to OpenAI. And investors are starting to get a little nervous here that if OpenAI can't fund their massive spending plans, they have huge ones, well, then Oracle could be left holding the bag, especially since Oracle has taken on a gigantic debt load of over $100 billion to build out these AI data centers now, which has basically wiped out their free cash flow for the time being. However, if those fears are overblown in any way, which I suspect they might be, then the stock looks dirt cheap now after the crash, with numerous metrics that trade significantly lower than the sector, including a PEG ratio that is about 34% lower than the sector and a whopping nearly 50% lower than their own 5-year average. And even if OpenAI does scale back, I suspect that the demand for data centers will still be so high anyway, regardless, that Oracle will likely just rent that space out to someone else. Plus, don't forget that they even own a 15% stake in TikTok USA now too, which could be a sleeper hit for some added revenue growth down the road. So, considering that analysts now price the stock to nearly double over the next 12 months, which is in stark contrast to that of Caterpillar, which I just showed you, well, I will very easily rank this one higher on our list too. It's not a stock that I own yet myself, but I am heavily, extremely considering it. And don't be surprised if I just let you guys know that I do own it. I ended up picking it up while it was down here because it is looking very good. Okay, moving on to purchase number 3, though, we actually have another super popular name in artificial intelligence. Very important one, really, for the red hot memory chips market that has been soaring lately. You guys have probably seen this. But that is, of course, Micron, ticker symbol MU, which BlackRock added another $1.5 billion. Now, for anyone who isn't familiar with Micron, they are really one of the biggest hardware providers for high performance memory, which is crucial really to the AI revolution. So while companies like Nvidia and AMD get, most of the glory for their GPUs, well, those chips actually wouldn't be able to perform well without specialized memory and storage solutions that, Micron does provide. And while they specialize in DRAM and NAND technologies, the real growth engine for them lately, especially right now, is something that we call high bandwidth memory, HBM. I think of it like a super highway, but for data, where without HBM, from companies like Micron, well, those expensive AI chips from NVIDIA would basically be stuck in traffic. This makes Micron a critical AI enabler, and with only two other major competitors in the world, in Samsung and SK Hynix, well, they hold a really nice and comfortable seat at the table, a very lucrative one too. And because of it, their growth continues to smash records. In their most recent quarter, for example, they delivered a staggering 57% growth on the top line, while nearly tripling their profits too. And the crazy part is that management claims that their next quarter will break substantial records even further across every single metric, too, including revenue, margins, EPS, and free cash flow. A really crazy thing about Micron stock, though, is that, and it's almost like too good to be true, is that despite the stock skyrocketing recently, where it's more than quadrupled in price just in the past year alone. Pretty crazy. Here's a zoomed out version so you can see just how staggering that climb has been. Well, despite that, their valuation is actually still way cheaper than the sector by close to 50% on a forward PE and more than 80% on a forward PEG too, thanks in large part to their expected high growth in the coming years. There is a reason why Micron does tend to trade so cheap, though, and that's because the memory and storage markets are notorious for being very cyclical. Now, right now, supply is incredibly tight, with even Cisco recently warning that high memory costs are cutting into their profits because there just isn't enough to go around. And that tightness allows Micron to charge premium prices for the time being. However, because everyone sees how profitable this is, well, rivals like Samsung and SK Hynix are rushing to increase their own production of these chips too. Eventually, that could lead to an oversupply that does push prices back down, and we tend to see that happen in cycles. But for the time being, maybe even for a few more years, business is definitely booming for Micron. And with tech giants slated to spend over 650 billion on AI infrastructure this year alone, well, demand is likely to remain extremely high. Personally, it's not a stock that I own myself, at least not yet. Never really been a huge fan of all that cyclicality, trying to time all that. Really like to just kind of buy a stock, hold it very long term. And so because of that, I would still prefer something like Oracle instead, who I feel fits that a little bit better. But hey, I do think Micron does hold a lot of promise long term too. And I wouldn't even be surprised if they break $1 trillion market cap in the future, which they would have to more than double in size from here in order to achieve that. So I will rank them higher than Caterpillar for being a better value play. But I am still going to push Oracle up one spot to keep them at a higher ranking because of how much I really do like their software ecosystem right now that they've built up. Micron is a close number two, though. Okay, interestingly, at purchase number 4, well, we have another chips related stock. This time, though, it is in Lam Research, ticker symbol LRCX, which they increased their position on by over 8%, adding an additional $1.5 billion worth during the quarter. Now, if you want to understand what makes this company so special, well, you'll have to look past the chips themselves and rather look at the actual machines that are used to build them, which Lam happens to be one of the biggest suppliers of in the entire world, providing the wafer fabrication equipment, what we call WFE, that foundries use to manufacture chips. Specifically, though, Lam specializes in what is called etch and deposition. See, over time, chips need to become more powerful while still being efficient. And because of that, they continuously get smaller and more complex with each new iteration, especially memory chips used in AI that stack hundreds of layers vertically, which you need insanely precise tools to be able to carve and layer those materials. Well, that's exactly what Lam sells. And because those markets are in such high demand right now, especially with all the memory shortages going on, well, companies like the ones that I mentioned earlier, Micron, Samsung, SK Hynix, and more, are all frantically raising their capital expenses to bring more production online. In fact, Micron just raised their CapEx budget by 45% to around $20 billion this year, just to try and fill that demand. Well, as these manufacturers rush to build out capacity, they have to buy more equipment that, again, Lam Research happens to sell. And so, like the others, the result has been exploding financials on both the top and bottom line, with revenue last quarter, for example, jumping over 20% year over year, while net income soared by over 30% too. Personally, I expect that type of growth to continue throughout the coming year, as management is even forecasting now that industry wide spending on fabrication equipment will hit a record $135 billion dollars for the first time ever this year. Unfortunately, though, similar to Micron, a lot of this hype has actually already entered the stock, with the price nearly quadrupling over just the past few years alone. And unlike Micron, that is, still trading cheaper than the sector, Lam is actually significantly more expensive by around 50 to even as much as 90% on certain metrics. And normally I would argue that a company performing this strongly may in fact deserve that substantial premium. But because of the cyclicality of the semiconductor equipment market, where downturns can sometimes even cut sales and profits by large amounts in a single year, I'd have to give both Oracle and even Micron an edge here on our rankings for the much lower valuations. And because Caterpillar is at least a bit of a different type of business, focusing more on industrials as opposed to the other three tech stocks that we have, I'm actually going to give them an edge here too, just for like diversity's sake. So even though I do really like Lam Research, unfortunately, they are going to take the last place ranking by default. All right, guys, last stock on the list. And this was actually their biggest purchase of all. And it is in yet another chips related stock. But this time it was in AMD, ticker symbol AMD, of course, which they added more than $2 billion more during the quarter in stock, bringing their total stake in the company up now to a whopping $31.5 billion. And look, with this one, despite having a strong run over the past few years, more recently, when you look at the stock, it's actually dipped quite a bit, losing over a fifth of its value from the top over just the past few months. A part of that decline, has also been attributed to their most recent earnings that really spooked investors, resulting in literally their worst trading day since 2017. And yet, I actually thought that the results were very strong, beating on both the top and bottom line while also growing sales by a massive 34% year over year, which is a new record high of almost $10.3 billion, also posting record profits of nearly $3 billion in operating income, which was also up close to 50% too. It actually doubled on a GAAP basis. And their most important business of all, at least for AI, their data center business, grew by a whopping 39%, up to nearly $5.5 billion. So to be clear, this was not a weak quarter at all, really. It was actually a pretty strong one that continues to showcase high demand for their chips, especially given the rise in artificial intelligence. In fact, the only reason that the stock fell, at least in my opinion, had to do with guidance that, according to CNBC, actually still beat expectations, but apparently it just wasn't a big enough beat to impress investors after the stock price had already doubled over the past year, which is a bit of a trend that we've been seeing this earnings season too, right? Like, some of the hottest stocks kind of cooling down a bit and even correcting, as investors not only expect some of these names to beat expectations, but now really want them to actually destroy them because of how high their stock prices have climbed. And so they're just kind of having greater and greater expectations as the valuations get larger, which I know doesn't make a whole lot of sense here for a company that is actually still performing incredibly well. But it is a little bit of a situation that we're in right now, as the stock market at large does continue to break new record highs, which was largely driven by some of these more popular tech and AI stocks to begin with. So, hey, at these lower prices though, AMD is at least starting to look more attractive, especially as they work to release new products in the coming year, including their new MI450 and MI440X chips and their Helios rack scale AI platform too. The company is also coming off landing some huge customer partnerships like with OpenAI and even Oracle. So I actually think that the best is yet to come for AMD. I think they're a solid alternative option for CPU and GPUs alongside Intel and NVIDIA. NVIDIA is seeing so much demand that I don't think they can really meet at times. And That makes AMD a good alternative choice at lower price points. And with the haircut in price now, even their valuation is looking a little bit better too, with a PEG of less than one, that's more than 50% cheaper than the sector median. It is going to be a little tough to rank them though against Oracle and Micron, but I think I will continue to give Oracle the edge here for what I feel may have the best combination of both value and future potential. But hey, not a bad group of stocks here at all, guys. Most of these actually, I think, make perfect sense. And while I do think Caterpillar and probably Lam Research are just too expensive to be buying at the moment, Oracle, AMD, and Micron could be solid pickups, but especially Oracle, I'm getting super tempted to buy that stock myself. Let me know how you guys feel about these. Do you own any Oracle stock? Do you think I should buy it? Let me know down below. And yeah, I hope you enjoyed the video. Let me know if you agree or disagree with anything I said, but I will catch you guys in the next one. Hope you're all doing well. Take care, my friends. Bye-bye.